Good morning and welcome back to Almus Market Mornings. There are a few stories to catch up on today morning as we start the day with a solid rally in gold prices, which have already crossed $4,400 per troy ounce. What's interesting is this time around, gold is rising alongside higher yields and oil prices. Oil remains under pressure. We have no signs that geopolitics is getting any softer. President Trump now has demanded repatriations from Iran for the war, and it looks like both the sides are moving to their own extremes. Yen weakness is again in focus. It's wiped almost half its rally from the recent joint intervention between Japan and US. And it looks like without further intervention, maybe the yen may slowly drift back towards its pre-intervention levels. Good morning, JK. A lot of threads to catch up on. What's your take on the recent gold moves? Because that's been the attraction among market participants.
Hey, good morning, Swaraj. Very interesting, very solid move on the gold. Not long ago, we had seen 3950, and today we have crossed 4,400 so easily. And that clearly shows how the market was positioned. And in the initial stages, if you recall, I was also saying that this bond sell-off might be resulting in some diversification into gold also. And that has really picked up momentum. So recently, also heard about Chinese increasing their gold purchases, and then South Korea starting to buy gold after a gap of 13 years. So these have really added to the positive momentum on gold, and having crossed 4,400. Think 4,600 becomes the next technical target where it may pass, not because the reasons are going away, but because it can become a little bit overbought also. So, but yes, the underlying trend seems to have resumed. So let's see how far whether it goes towards 5,000 eventually or not. Yes, but Swaraj, if you look at it today, we have had some not so good headlines, many headlines, in fact. One of them which hit me was the stocks of crude oil in the US Strategic Petroleum Reserve fell to the lowest level since 1983. And we have been talking about this factor coming into play because the home state is not fully open and the ship movement is also very limited. Then we also had a headline from Iran, which says probably they will stop negotiating with President Donald Trump during his remaining time in office. That is talking about under 2 years, more than 2 years, in fact. And until he ends his trend in January 2020. Now this, I mean, it may be not so eventually, but then that shows the what kind of view they are having, what kind of difficulty they from their view they are facing in getting the negotiations move forward. So, I mean, if that really happens to be so, then while we may have some relief here and there, but overall situation is not going to get normal very soon. And the other one, which you also mentioned, that the President Trump, in fact, now suddenly started to ask for reparations for the damage that Iran has, human, tragedy or killing of soldiers on the US side and all that. For that, he's asking for compensation from Iran. So it also, his response to Tehran's demands was also very, nothing much that he actually said, and no real pathway that he has given for further negotiations. So all this has resulted in oil prices going up once again by 4%. Now, notable thing is that while yields have logically, of course, gone up again, 10-year went up by 5 basis points again, and even the 30-year is up. And the market is once again looking at much higher levels in the yields because of the oil prices. Now, the thing is, we are also heading into CPI and PPI number this week. The more influencing factor is the large amount of 125 billion of new funding that the Treasury has to make this week. And this is coming at a time when bond market is shaky. And if, there is poor response for these funding activities, then we might still be we might well be looking at a very weak job bond market, and that could also affect the other risk assets, and that is where even gold is actually gaining also. Coming to the dollar yen, of course, again crossing 159 after, of course, the joint effort by US and Japan to strengthen the yen. It looks like, Japan is once again taking a very passive approach to the intervention or to strengthen the yen. And some analysts even feel they're okay if yen stabilizes below 160 or around 160 levels. It's not that they want to strengthen the yen. Otherwise, they had a few opportunities. They could have actually hiked the interest rate by 0.25%, or on last Friday when there was a weak jobs report from US, and the dollar was starting to fall. That was an opportunity that they could have used to sell the dollars against yen, but they did not do that. So now yen is back again, moving towards 160. It's not very clear whether how serious they are about strengthening the yen, but probably they are not. They are, of course, don't want yen to weaken beyond 165. That's very clear. So it's a very interesting situation. Whether they use today's Japanese holiday thin market to intervene is something that the market is actually uh, looking at. Now, interestingly, one of the Fed members, Beth Hammack, actually now countered Kevin Warsh. This is the first time we are seeing that for a Fed member actually opposing what Kevin Warsh has been saying, in a way, not mentioning directly, but he said. He says markets are a complement for the Fed. They are not a substitute. This should be seen in the context of what Kevin was said, that markets are doing his job. So because yields have gone up, he said we are not raising the rate, but market yields have already gone up and financial conditions have tightened. So that's one point that he also said. He's also made some comment about why forward guidance is also important. Not that you have to say when we are going to hike rate and something like that, but he says American public should be made known about our intentions on how we are going to go about delivering the commitment. We keep talking about 2% inflation target being non-negotiable, but there is no pathway that is being mentioned, except that we keep saying that we'll meet it. So, saying that does not mean forward guidance in Hammack's view. It means helping to explain our reaction function and telling public how the new piece of data which comes in will impact our overall approach to the situation. So interesting comments and headlines. That's how the Tuesday morning has been. Dollar other than yen has been in a very, very tight range. Again, some thin markets because of vacation period, but all the movement that we are seeing is in the yen and in the gold, and for good reasons, of course. The bond yields moving up against, and more repatriation, or rather the diversification into gold is what we are seeing. On rupee, one of the tightest ranges in the last several weeks is what we have seen. Both sides very strong, buying as well as selling. Sometimes you heard that the PSU banks have been active on both sides, buying as well as selling. But the good news is that the Forex program that government, or rather RBI, initiated in June has now garnered about 47 billion of total flow. So out of which it is about 43 billion has come through FCNRB deposits. And this is a substantial acceleration from 36.7 billion that was reported on 31st July. The latest numbers have been reported as on 6th August. And now the thing is, even the estimates are further going up. Now some people are estimating that well cross 80 billion also under FCNR. And it won't surprise us because we still have about 10 weeks to go. Sorry, rather, it's about 7 weeks to go for this. So that may be still a possibility. So rupee still, I think market still assessing, caught between fresh rise in oil prices, at the same time positive news on the inflows. We even had a positive flow for the equities from the FIs yesterday. But I think Indian markets are also on a holding pattern right now, not moving much, and still weighing which side to lean on. I think what eventually moves the market is the bond market trend. global bond market trend. Because if the yields keep going up without being countered by any action, then that could create a lot of negative reaction in other markets, and the Indian market also could get affected. The other possibility, the opposite possibility is that in order to control the yield going up, the US Treasury resort to some sort of a yield curve control program, or you can say some QE in some sort, some other name maybe, which could weaken the dollar. Which I think they are not going to worry much about a weakness in dollar. Rather, they would like to save their stock market and the bond market. So, very interesting time. What happens in the bond market going forward, particularly in view of the inflation numbers as well as the large amount of funding, fresh funding that the Treasury has to do, and how they react to yields going up further. These are the what is on our radar. Thank you.
Thank you, JK. And yes, we have the CPI, PPI data. That is something to look forward to, significant data points. But apart from that, as JK mentioned, not so good headlines. Crude oil stocks in SPRs are at the lowest levels since 1983 for the US. And I'm pretty sure that that's the case for many other countries. The SPR might be at lower levels because after the initial release, they've not been really able to have a stable sort of price to start refilling such kind of supplies. So it may be something that may be more broad-based. Oil prices, they are elevated. Yields have again gone higher, putting pressure on yields. Maybe one more aspect that the US Treasury has to fund about $125 billion of maturing Treasury bonds this week. It's a very large number, and that may itself put some pressure on the bond markets. The two big movers have been yen, which has crossed 159, and gold, which has crossed $4,400 per troy ounce. Apart from that, dollar index largely remains in a range. Rupee again in a range with PSU banks active on both sides. $43 billion have come through FCNRB as on 6th August, which is very large and healthy number. And we still have 7 weeks to go for the scheme to come to a close, and the estimates are going higher as to what can be expected with respect to these flows. So we'll keep tracking all these narratives and threads. That's it for now from us. We will catch up tomorrow with a fresh round of updates. Thanks for listening.